What's up everyone, it's Caddy with Money Investing Real Estate. So Dalton and I figured we'd do another video going over our spreadsheet, which is our Bible, so to speak, in the real estate world, because this is the spreadsheet that we use to analyze deals. We run the numbers using this spreadsheet and we pretty much account for all income, all expenses, and then also figure out what the return is going to look like. And then we do that comparison for that return with alternative opportunities, because as you guys know, with investing, everything's an opportunity cost. If you are investing in one asset, you are giving up on the opportunity to invest in another asset. So I let Dalton once again introduce himself a little bit, and then we'll share the spreadsheet. We'll walk you through the entire spreadsheet, go over the income section, the expenses, the summary, and the different returns that we look for based on the cash on cash, the cap rates, and the different budgets that we have, different buckets that we have created within that rental property analysis spreadsheet.
Yeah, awesome. So thank you, Caddy, again. Awesome to be here. In our second video, like you said, we're going to go over our spreadsheet. And the main part of this is just be realistic with all your numbers, gives you that realistic approach and what you can kind of expect, and always be a little bit more conservative, so that way when you get your deal and it's locked in, it looks good, you're ready to pounce on it. So
yeah, no, I think that's a good point that you brought up, conservative and being realistic, is because those are two key variables that we also apply when it comes to investing in the stock market. We always want to go with a very conservative approach if the reality is even slightly better than what we expected it to be. That's what I consider to be the cherry on top. But I don't want to be banking on the best case scenario, because if it doesn't pan out, then you are in trouble. So one of the things that I like to say in the Money Investing Real channel is that I'd rather be conservative and right than be aggressive and wrong, because you don't want to be aggressive and wrong. You much rather be conservative and right. So here's the spreadsheet that we're going to go over. I'm going to walk you guys through the income section and really go over the different things that we account for when it comes to income. And then Dalton will break down the expense section of the spreadsheet. And we'll kind of walk you guys through on this summary page where we look at the different cash on cash returns, the purchase cap rate, the cash flows that we look for, and just the different net operating income that we're targeting. So on a very surface level, the first few columns or rows that you'll see is just the name of the property, right? So you're putting in the property address, the city, the zip, the state that it's located in. So since Dalton and I are currently looking at properties in Texas, specifically in Dallas, so a lot of the properties that we'll end up putting in are going to be ones located in Dallas and Texas. Then we come to annual property taxes. Now, these are going to be listed on the property listing itself. Most oftentimes, it's going to be a percentage of the assessed value. So you can pretty much find that on the listing. And this will be calculated in itself. So this actually is not an input. By the way, just a quick overview. Everything that you see that has input next to it, like for example, on this side, you've got a lot of inputs. These are things that you are putting into the spreadsheet, and everything that doesn't have that, you're getting an output from the spreadsheet. So there's a lot of formulas already plugged in. Once you've put in your inputs, you're going to get a lot of outputs for yourself. So the first things first, we put in the property, where it's located, the name of the property, the street, all that stuff. We put in the purchase price, what the planned purchase price is. So for example, in this example, let's just go with $250,000. So now it comes to your after repair value, which is just a summation of your purchase price and your estimated closing cost and repair cost. So this right here are the two inputs that you're going to put in. And Dalton, what did we say? What's the percentage that we use for the closing cost and estimated repair cost? Now the repair cost obviously depends on the quality of the property as well. If it needs a lot of work, you'll put in more, versus if it's like fully well done, maybe not so much. But what's a typical percentage that we use?
Yeah, we usually end up using about 1 to 2%. Obviously, it ends up closing costs considered dramatically based on the percentage of down payment you're going to be putting.
Right.
So it is, depending on that, is a factor in that. But usually we can, especially in Texas, it's about 1 to 2%.
Okay, perfect. So purchase closing costs, we'll put in 1%, so 1% of 250,000, 2,500. And then repair cost, as I mentioned earlier, depends very much on the quality of the property. If it's completely turnkey, you maybe don't need as much, but sometimes you need appliances. Sometimes, property may not have like a dishwasher or washer, dryer. So those are things that you may have to budget for. What's a good percentage for this, Dalton, that you would probably go with?
So especially with Caddy and I investing out of state, we're going to be relying heavily on a property manager and real estate agent. If there's something our agent comes back to us and say, hey, this might be something we see as a big ticket item, we'll have them walk with a contractor to, again, get us realistic numbers on those. But say if it's just appliances or it might be some flooring, we have general ideas on that. So depending on the square foot of the place, it's about $250 a square foot. So say 750 square foot, and we have to do flooring, we'll put $1,400 in.
Right.
If we know we need dishwasher, all the appliances, there's always great bundles at Home Depot.
Yep.
We can do $2,000. So roughly, usually we'll put in repair costs of $5,000 on the lower end.
Right, perfect. So I put in 2%, that comes out perfectly at $5,000. That's your estimated repair cost. Now this is where your loan comes in, right? So obviously a lot of the best return that you're going to get with real estate is if you are taking advantage of leverage, right? Leverage meaning you're taking on a loan. Of course, you can buy all cash, but our goal would be to get financing so that we take advantage of that equity pay down. So over here, all we're gonna plug in is how much we're planning to put down. And one of the things that you have to understand, obviously, is that if you are doing an FHA loan, and if the down payment is less than 20%, you have to account for PMI under your expense column as well. But of course, if it's over 20%, then you don't have to account for it. So we're gonna plug in, let's say 20%. So the down payment amount is gonna be $50,000. That's simply 20% of your purchase price. That's something that you've already put in. Now, interest rate, obviously in the current environment, interest rates are running really high. So typical interest rate, Dalton, would be around 6 to 8%, I'm assuming, on a conventional loan.
Absolutely right on, yeah.
So let's just put in 7% here and amortize over. So that's your terms. Are you doing 15 years, 30 years, 10 years, whatever the case may be? So most conventional loans are 30 years. We're going to put that in. And now automatically it calculates your monthly mortgage expense. So $1,330.60 is going to be that monthly payment over 30 years at a 7% interest rate. Once you are basically financing 80% of the property at $250,000. We've got another spreadsheet here, which is the debt schedule. So if you come down here, this basically shows you the entire amortized debt. So this is payment by payment each month, breaking down your beginning balance. You're basically financing $200,000. Your payment's $1,330. How much of that is going towards interest? How much of that is going towards principal? And what's your ending balance? And then coming all the way towards the end, this is when you pay the property off at your payment 361. That's over a span of 30 years. So that's also available for you to kind of visually see what it looks like. And total payment is for $479,000. That's including interest. But going back over to the spreadsheet, so the income section is really only accounting for the property itself, the amortization of that property, so financing, and the most important, probably the metric when it comes to income is rent, right? How much are you going to charge the tenants to be able to live there? Now, there's a lot of research and analysis that goes into it, and Dalton and I have figured out a strategy to get as much information as possible to extrapolate the best possible rates. And sometimes even the market will determine that rate for you. So you can maybe start high and then knock the rent down by $50 each week if it's not being rented out. But the best strategy for us is to really figure out what's the median income, what's comparables like similar properties, what are they renting for, get a hold of a couple property managers, get a hold of a couple different people in that area to better figure out what the rents might look like for that area. Now, in the book, Rental Property Investing, there's a very simple test. It's called the 1% test, which tells you on a very surface level whether that property will cash flow or not. And the 1% test is basically your purchase price. You take the 1% of that purchase price. So in our example, if $250,000 is our purchase price, we take 1%, and that should be your monthly rent in order for that property to cash flow well. And by cash flow, I mean net cash flow, not just taking out your mortgage expense, but after all expenses, which Dalton will go over here, which is very, very important. So that's the 1% test. Now, in New England, it's going to be difficult to find anything that's $250,000 that's going to be renting for $2,500. Dalton, correct me if I'm wrong, but the market's just way too hot. But in Texas, maybe. It's possible, it's difficult, but that's why we're doing this analysis to figure out, okay, what's the sweet spot between the rent and the purchase price after accounting for all expenses. But now I'll kind of switch over. I'll let Dalton talk about expenses here. We've broken them down into fixed and variable.
Yeah, awesome, Caddy. I think you explained that perfectly. Our cash flow looks great right here without any expenses. If we can do that, it'd be fantastic. But yeah, so going through the expenses, Caddy and I are primarily looking at the single family slash condominium route. So electricity in most cases are covered by the tenants. So in this category would have to do zero. Some multifamilies, if there's one electrical, then you would put that in as expense. But for the most part, for Caddy and I's investment strategy, it's mostly going to be zero. Water and sewer, it depends. If it's a single family, the water and sewer can be paid by the tenants. In a condo association, this is going to be covered in the HOA fees. So we can also put that as zero because we'll have an HOA fee in there as well. PMI, private mortgage, private mortgage insurance, and something that I learned in our first investment property as well with doing an FHA loan, which is actually called MIP, which is monthly insurance premiums on an FHA loan. So I figured out if you do less than 10% down on an FHA loan specifically, that MIP insurance is going to be for the life of the loan. It never falls off. PMI, if you do a conventional loan on 5%, anywhere between 5 to 20%, you get the PMI insurance. That'll fall off after you hit 22% of your loan. So that's something to keep in the variables, and that will jump off later on the road.
So quick
But with an
question
FHA
before you don't, sorry to cut you off. So if it's an FHA loan and you're putting 3.5%, you're paying an MIP that never falls off from the life of the loan. With a
Correct, yes.
conventional loan, if you're putting down less than 20%, that falls off after 22%.
Correct.
But
And
what
that
if
was one of our biggest
what if
learnings.
you are doing an FHA loan but you're putting down more than 20%? Do you have MIP at that point?
Nope. If you
Okay.
so anything lower than 20, you'll have MIP. However, if you put 10% down on an FHA loan, which you can do, you will have MIP, but it'll only be on the loan for about 11 years, and then it will fall off.
Okay.
So anything on the FHA loan less than 10%, you'll have MIP for the life of the loan.
Right.
Anything above 10%, you'll just have it until you hit that 22% sweet spot
Right.
there.
No, the reason I ask is because there's a very subtle difference, and a lot of people, like I learned it from you, that an FHA loan at 3.5%, the MIP never falls off. It's almost always there through the life of the loan. You're just paying extra for no reason, right? Even after you've kind of achieved that 22% threshold.
Absolutely, yep. And then garbage, it all depends on what property you're looking. If they have, if the city has garbage that is covered through the city and your fees for property taxes. If it doesn't, that's an expense you can put in, but sometimes it's not covered. So you'll want to know that. HOAs, you're going to want to see what the HOA is. Sometimes it is on Zillow, but that is something you can confirm with your real estate agent wherever you go. You're going to want to know what's covered. If water and sewer is covered in it, some of them are not. And then you go into homeowners insurance. Homeowners insurance is going to vary considerably depending state to state. So always reach out to your local insurance agent to get a most realistic. And again, anything you do in real estate, you should really get 3 quotes to get the most realistic number. And then you can add an average of that to get into there. Property taxes, we didn't actually put it in as an input on the left side. If Caddy did put property tax as the input on the left, it would automatically put it into the right there as well.
Yeah, so it's just a monthly number that you put in. So for example, if you're paying $125 property taxes, then automatically it'll calculate on this side the annual property taxes $1,500.
Perfect. And then other monthly expenses, this could be anything that you find throughout your loan that you might have to pay for those tenants, whatever it may be. If it's heating and cooling, say that's something that you're going to cover in your lease, that's something you can add in there as a random monthly expense that could variable. And then we come down into the vacancy rates, repairs and maintenance, CapEx, and management fees. Since Caddy and I will be out of state investing, we reached out to a couple property managers. A lot of property managers have their fees right online. Some you do have to call, but we found it at an average of 9% is more than aggressive enough to make sure the deal works for us. Capital expenses, we did 5%. Most people do 10%. And the reason we did CapEx at 5% is because we are looking right now at the condo route. And with CapEx and the condo association covers a lot of the big expenses. So we really don't need to be holding 10% into that fee every month. And those are the big ticket items. So that's why we have 5%. Repairs and maintenance are all the little items that we put 5% towards as well. That could go wrong throughout the tenant. So we have a little bucket for that as well. And then vacancy rate is anytime the unit's vacant, right? So if we have to turn over a unit and it's going to not be rented for a month, we want to have that bucket so we can pay for that mortgage without taking a cash flow negative that month as well. So those are our buckets that we keep, a little safety net. And it looks like for the rent at 2,500, our total fixed variable expense is a percentage of the total rent that gets that as well.
Right. So 5% of the monthly rent goes towards vacancy, 5% repairs, 5% capex. And as Dalton mentioned, I mean, again, depends very much on the quality of the property, what we're actually buying. If it's a single family, multifamily, then this may go up to 10%, maybe even 11, 12%. A management fee is, depending on the area, depending on what services they're providing us, can vary anywhere between 6 to 12%. So I think 9% is pretty average over in Dallas, Texas. One of the things that I wanted to point out is that these fixed expenses that you have over here are throughout the life of the property, right? So they're almost always going to be there. I mean, people will always need all these utilities plus insurance plus property taxes. I mean, this will always be there. But with the variable expenses is that what we figured out was once we have gotten to a certain level, we don't really need to be saving for these items. And it also helps once you've got a lot of properties, because then you start kind of working through like an insurance policy where once you've got a huge amount of capital pool for vacancies, capex, repairs, then you can use that pool for multiple properties and you don't need to save for individual properties, because not all your properties are going to be vacant at the same time. Not all the properties are going to need those capex or repairs all at the same time. So what did we decide the numbers were? Dalton, again, depending on the values of the property and how big it is. But I think we discussed 1 year's worth of rent on vacancy.
That's correct, yep.
So 1 year's worth of rent, and then repairs, maintenance, and capex. What would you say is the appropriate amount that we need to save up to, and then we can stop saving for it?
I think we spoke about the capex and repairs maintenance at that $10,000 mark is our sweet spot for the condo route. If it's a single family, we'd probably go up to 15,000, just because we might have to foresee bigger capex expenses in that category.
Right. And what would you say are the biggest expenses from a capex standpoint for any property? Like I'm assuming the roof, the floor.
So it's definitely going to be the roof. It's going to be the heating system. It's going to be oil tanks. It's all the big things that could go wrong.
Big ticket items.
Hot water heaters aren't that expensive, but could be.
Right.
But all the little stuff is in the repairs, but the big ticket items that are going to cost you a few $1,000s every time, we go into that capex expense.
And then what would you say, where would you put like lawn care, fencing? Like is that going to be under property management or other monthly expenses? Where would you put that?
I would put that under other monthly expenses.
Other monthly expenses. So if there's a lawn, there's a big backyard. Dalton here loves to lawn his backyard, but yeah, I mean, so the thing with property management is that you almost always want to account for property management, even though you buy in an area that you may live. And even if it's around your area, you still want to account for property management, because as your portfolio grows, you're not going to be able to be at all your properties. So if you're accounting for it from the get-go, it makes things a lot easier over time. But yeah, if a property has a big lawn, big backyard, you definitely want to be accounting for that as well. Snow removal over the winter, I'm assuming that's also going to fall under the monthly expenses.
Absolutely.
All right, so just hypothetically, let's just plug in some numbers so we can kind of walk through this section of the spreadsheet. So let's just go with, you want to throw in some numbers there for any properties, let's say in Dallas, Texas, for $250,000.
Yeah, so typically water and sewer, say if we had to pay this, it's usually a quarterly thing. So we'll say $180 a quarter, so $60 a month.
Okay, perfect. And then electricity is going to be paid by the tenant. PMI, we're putting over 20%. Garbage, I'm assuming it's taken care of by the HOA.
Yeah, we can assume that for this time,
right.
Yeah.
So what would you put for HOA? Typical HOA, the properties that we've been looking at have been somewhere between 175 and 280, 300 HOA roughly.
Correct, yeah.
So let's just put 250 here. Homeowners insurance.
On a condo, it's not going to be that expensive. I would say $70 to be safe.
Okay, perfect. And property taxes, I think we've been looking at around $200
a month, yeah.
per month. And then other monthly expenses, you may want to put down, let's say $50.
Yep, that'll be a good safety net.
Perfect. So we've got most of the fixed expenses down here. We've got the vacancy, repairs, capex, and management fee, all the variable expenses. So now our total operating expenses, in order for us to operate the property, comes at $1,230, just as a hypothetical example here. And then the mortgage expense is around $1,330. So you'll notice that the total monthly expense is a combination of both the mortgage expense and the operating expense, which comes out to around 2560. So that's what this column over here shows. The monthly expenses 2560 and our monthly income is 2500. So we are on a net basis not generating cash flow. So this property is losing us $60 per month. Now, obviously, if we didn't account for any of the variable expenses, which a lot of people do in the real estate world, they're like, hey, as long as my rent pays for my mortgage, I am fine. So if we do 0% here, 0% here, 0% here, and now you'll notice that all of a sudden we jump to $539 in monthly cash flow. Our cash on cash also jumps to 11%. But the only problem with that strategy is that, again, you are banking on the best case scenario. You're expecting nothing to ever go wrong, your property to never be vacant. There have to never be repairs or maintenance or capex, and which we know in the real estate world is not possible. So that's why we account for these things. And now we get to a point where we start working with the numbers, right? So what if we put in an offer for $200,000, right? And then now 20%, or we put down a little bit higher. So let's say if you go with 40% down payment, now you'll notice that our mortgage expense just went from $1,330 down to $800. Again, these are just examples right here. Obviously, no one's going to sell their property $50,000 below asking in the current market, but this is where you get to play with the numbers and see what works best for you. The things that we target are cash on cash return of about 8 to 12%. So anything between 8 to 12% makes a lot of sense for us. Cap rate is going to be somewhere.
Why are we targeting between 8 and 12% specifically?
So yeah, cash on cash is really like how much money you were investing into the property and how much return you were getting in terms of cash. And that's accounting for after all expenses that we just talked about, right? So all these fixed and variable expenses. So you want to earn at least 8 to 12% because as we know in the stock market, you can do 8% on a long-term basis from the S&P 500. So in order for this to be worth it, we want something that's market beating. Now, even if it is not market meeting, like for me personally, and maybe Dalton's threshold is going to be a little bit higher, I'm even willing to go with a 6% or 5% cash on cash. And the reason for that is because it is almost guaranteed. With the stock market, 8% is a long-term average, but it's not guaranteed. Some years you're losing money. Some years you might, like last year, 2022, the stock market was in a bear market. People lost 20% on average by being invested in the stock market. But with real estate, as we talked about in our first video, there's a greater degree of control. Yes, you're going to maybe make a little bit less in the market, but it's almost guaranteed. You're going to be renting out the property. After accounting for all expenses, you can expect to make at least 5 to 6%, not to mention the equity pay down from the tenant, not to mention the capital appreciation of the property and the tax benefits. None of that is accounted for in the cash on cash. So I even have a little bit lower threshold than maybe Dalton. I don't know. Are you 8% or higher or?
I like to stick in between that 8 to 12%. And the thing is, in this competitive market that we've seen in the real estate market over the last couple of years, especially, a lot of investors are like that. They pivoted their strategies to go down to, okay, you know what, right now in this market, I'm okay with 6%, and that's okay too. Whatever you're okay with and what you'd like to see in the long term, if you're getting other gains, that is going to be your competition, and that's okay too.
Right. So yeah, that's the bottom line. And then cash flow, your cash on cash is basically a calculation of your annual cash flow, so annual net cash flow after accounting for all expenses, divided by your total cash needed to close the deal. And this $86,500 is a combination of your down payment, your closing cost, and your repair costs. So once that accounted for, that's your total cash needed to close the deal. And your cash on cash is simply a annual net cash flow divided by your total cash needed.
All right, so everyone, this was just a brief explanation of what our sheet looks like in terms of expenses, just a hypotheticals, obviously a lot of these, and another video Caddy and I can pull directly into maybe one of the properties you guys put in the comments. We can analyze that deal for you guys and see what it really looks like. However, these are hypotheticals. You're really going to want to look at, say, oh, I can never find a property at $200,000. You can, but you are going to want to look at, make sure the numbers work. Those properties at $200,000, we're seeing some in $100,000 range in Texas, so those are out there. Look at the gross monthly rents, see where those are, use the property managers like we've said, and just overall look at this deal. You're always going to want to be realistic, get comfortable with your spreadsheets, analyze 10 deals a week, get really comfortable with it, so that way when you do see that purchase price, you know the area that you're investing in, what it's going to rent for, and you can quickly say, hey, this property might work. But like Caddy and I like to do, And same thing in the stock market. There's a lot of houses out there. There's a lot of stocks you can invest in. You want to go through this process and say, how do I say no to this deal? And when it does say yes, that's the one you're like, okay, this is a good deal for me. Let's do it. And that is everything we wanted to share with you today on our spreadsheet.
Yeah, and the beautiful thing about the spreadsheet is that all the numbers you can play with, and they will change. I mean, rates right now are at 8% or higher, so your monthly cash flow looks pretty bad. But if and when eventually the rates get cut, right, the Federal Reserve maybe next year starts cutting rates and they get down to, let's say, 5%, then all of a sudden your mortgage payment is a lot lower. And one of the things that we've also talked about is that yes, you can pay a higher rate today, but say 3 years, 5 years, 7 years down the road, you can refinance a lot of your properties at a lower rate, thereby increasing your cash flow. So a lot of times real estate is not a way to make money today, but it's a way to make money tomorrow. And that's really the whole idea, is that we want to compound over several years so to get to a point where the cash flow enough is coming in passively and we're able to, again, continue to grow our portfolio of properties. So that's going to be it for today, everyone. Thank you so much for joining. We really appreciate you, and thank you for all the subscribers. First video got a little over 250 views, so thank you so much. Make sure that you drop a like and subscribe. Dylan, thank you so much for being here. Thank you for your time. And in the next video, our goal would be to analyze a real deal, analyze a real property in Dallas, Texas, run the numbers, run the cash flow, and have a discussion really on what things we can change, what type of offers we want to put in, and what type of financing we can find to finance those deals. So thank you so much for being here. Happy investing. I'll see you all in the next video.